Hello there! Following our recent video on the top 3 largest miners in the world, let's have a look at another 3, including Gold Fields, Kinross and Alamos. These 3 miners, based on the market cap, would also be in the top 7-8 largest gold miners in the world. And our valuation here is based on the data these 3 miners reported for the last quarter of 2023. Talking about our valuation model, the factors that go into the model are, as usual, we'll look at the scenarios for gold price, reserves and resources in the ground, the costs of extracting those resources, that's all-in sustaining costs we'll look at, long-term debts, taxes, per share value, discounted value, some insider source. And what we get as a result of the model is discounted per share value after all-in sustaining costs, long-term debts and taxes. Jumping into the gold price scenarios, we're going to look at 3 scenarios, with the balanced scenario still looking at the gold price of only $2,000, although it's already approaching our optimistic scenario of $2,300 per ounce. And our conservative scenario plugs in the gold price of $1,700 per ounce. By the way, with gold price rallying over the last several weeks, perhaps it's a good idea to check us out at myfinancesteacher.org for much more frequent updates, which could be that much more useful in the environment of volatile gold prices rallying so significantly in the recent weeks. Beyond precious metals, we do have a look at a range of other assets, including energy. Now coming back to our miners, we'll start with looking at the reserves and resources. We do look at the proven and probable reserves as well as measured and indicated resources, without taking into account any of the inferred resources or any further exploration success. And looking at the reserves, we generally see that Gold Fields is the largest producer, with over 30 million ounces of gold reserves and resources, followed by Kinross with over 20 million ounces in gold reserves and resources, then followed by Alamos with 4.4 million ounces in measured and indicated resources of gold and over 10 million ounces in reserves of gold. The situation is a little bit more equal for silver. All of these 3 miners combining reserves and resources of silver have anywhere around 40 to 60 million ounces of silver. Plus, Gold Fields has a little bit of copper as well at 336 million pounds of reserves of copper. Moving on to all-in sustaining costs, debts and taxes. For taxes, I simply assume a flat 25% tax rate to simplify and speed up the analysis. In this cross-section of all-in sustaining costs and debts, the eye catcher is Alamos with the lowest cost at only $1,150 per ounce in all-in sustaining costs and no long-term debts at all. Whereas the all-in sustaining costs for Kinross are at $1,360 per ounce and over $2.2 billion in long-term debt. Gold Fields has even higher all-in sustaining costs at $1,435 per ounce. All of these data are based on the guidelines for 2024. And as for long-term debts, for Gold Fields, those are at $1 billion, half of the debts that Kinross is carrying. Moving on to the shares outstanding as well as discounting, we do take into account the time value of money, although our discount rate is only 5.5%. Perhaps not high enough in the current relatively high interest rate environment, but we do expect several rate cuts from the Fed this year. As for the shares, Kinross has over 1.2 billion shares outstanding, with only 0.28% in insider hands. Gold Fields has nearly 900 million shares outstanding, with 0 shown in insider hands according to Yahoo Finance. And Alamos has nearly 400 million shares outstanding, with 0.29% in insider hands. Looking at reserves versus annual production, we arrive at the average mine life of around 11 years for Kinross, 19 years for Gold Fields, and 22 years for Alamos Gold. Adding half of M&I resources extends this average mine life. With all of this data in mind, we plug it into our valuation model, starting with the conservative valuation, where we plug in the gold price of only $1,700. And in this valuation, we only consider the proven and probable reserves of gold in the ground without taking into account any of the M&I, never mind inferred resources. What we get again is a discounted per share value after all-in sustaining costs, long-term debts and taxes which is only a bit over $2.50 for Kinross, around $5.7 for Goldfields, and just over $6.6 for Alamos. Clearly these values are below current market price, so treat it as some sort of a risk measurement telling us what might happen to share prices if gold price just drops out of bed here. Moving on to our balanced valuation, we plug in the gold price of only $2,000, and even in our balanced valuation, we only consider proven and probable reserves in the ground. This scenario gives us over $5.6 for Kinross, over $12.7 for Goldfields, and over $10.2 for Alamos Gold. Again, current prices are slightly higher than these. That's of course due to the current gold price being well above $2,000. So let's have a look at our optimistic valuation, which isn't overly optimistic at all. Our optimistic gold price is pretty close to the current gold price per ounce. And in our optimistic scenario, we consider the proven and probable reserves in the ground as well as only half of measured and indicated resources. Never mind any of the inferred resources or exploration success. And this scenario would give us $12.7 for Kinross, nearly $24.8 for Goldfields, and over $16 for Alamos Gold. Are these share values extremely optimistic? I don't think so. Are they likely anytime during this year? Perhaps. A lot, of course, depends on gold price. If it breaks above $2,300 and perhaps later retests the level as support, that's when the miners will most likely have to catch up to gold price itself. Before that happens though, before the market sentiment in precious metals gets to overheated levels, you gotta join us at myfinanceteacher.org for more insights. That's all for now. Have a fantastic Friday. Bye bye.